Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, November 11th, 2022. It's 3:09 p.m. Eastern Time. So I'm starting the video, but time in this one isn't as important. The only thing timely in this one, I'm just doing a quick update here. I'll start the video out with the NQ, the Nasdaq 100 60-minute chart. And same one I showed you earlier. There's that big, to me, 11,785-ish support level. You know, as expected, we've had a lot of momentum. We popped it slightly, but as I say, often breakouts that occur with negative divergences and overbought conditions often end up failing. So I still maintain at least another pullback. We already had one nice pullback off that level, and maybe that's it. But what I'm going to do in this video is twofold. We're going to go over let me back up. We're going to look at long-term charts, and what prompted me on this is a couple things. Number one, I maintain that the move over the last couple days is very typical of bear market moves when you get these one single day big gains. That I maintain. But as I also showed you in the statistics, that was 80% of the time comparable moves had a lot more downside to go in the bear market, and often were followed up within the next day or two with almost equally, if not bigger moves to the downside. So that's still there, but there was a 20% of those moves over the last all-time. That was the all-time top 20 moves in the Nasdaq, that chart I shared earlier. But the other 20% of the time, which is 4 out of the 20 incidents, they occurred after a bear market was over. So there's always that possibility. But what I'm going to do in this video, and what prompted me to do this, so when I see a move like that, especially not having been aggressively or adamantly bullish and long, which I wasn't, I take a step back and I'm like, okay, what am I missing here? So I poured through the charts yesterday, especially today, and I went through the components of the S&P 500. I probably cleared at least down to the top 50 or more, carefully studying the charts. And what I noticed, I want to say surprised me, but it doesn't surprise me, because what I noticed was there were numerous stocks, those that I had highlighted at the beginning of the year, and I'm going to give a link to this video. It was January 4th. I did an in-depth analysis, strongly and unwaveringly making the case not only for a bear market, but where we were going to go, and not only where the stock market was going to go, which got there, but where numerous stocks. So I'm going to go over not everyone in there because it's a bit redundant, but I'll go over about a dozen or so, and these are the leading companies. There's the Amazons and Microsofts and other big tech companies and semiconductors like AMD and ASML and Cisco, and the takeaway from this is twofold. I'm doing this because in reviewing those charts, I couldn't believe how many I came across that hit the targets I laid out at the very beginning of the year, which is also the very point of the bear. That's when the bear market started. That the S&P peaked right at the beginning of the year. And so number one, although I had been for the last few weeks fully recognizing and pointing out all the bullish developments, the positive divergence on the 60-minute and daily and weekly time frames, the big bullish engulfing candles that were put into the low, the big bear trap, I should have, in hindsight, especially the fact that it's not just the index. So many leading stocks hit major trend lines and key support levels that were laid out. So therefore, if nothing else, it's a missed opportunity. This is my mea culpa. I realized that I missed, even if this is just a bear market rally, which I still maintain it is, that I missed a lot of that stuff and should have been positioned swing and trend long in it, even up to this point. Even if the rally ends today and that's it, it would have been worth trading. So that's number one, looking back and recognizing where I missed, and now more so is going forward. Believe me, I've done this so long, and you do it long enough. The one thing you get comfortable with is losing money. You make a lot of money, and then you lose some money sometimes on trades, and nobody bats 1,000. And you do it long enough. If you've done this long enough, you know that you don't even bat an eye, and you also miss things. And so we're going to do that, but more importantly, where do we go from here? That's why I'm burying in the charts. That's why I'm looking at these charts, and we're going to go over this now. And I'm going to spend the rest of the weekend reviewing charts and trying to figure out, okay, this is a bear market rally, I still believe, or is that the case? Is it possibly the end of the bear market? And we'll get to that in a second here. But and then where do we go from here? So without further ado, we'll dive into the charts again. No change here. That's a big 11,785 resistance level right there on QQQ or NQ, the Nasdaq 100 futures. We already had that one pullback as expected on the initial tag, and I think we're going to get another one and a pretty healthy one. And again, this could mark the end of the bear market rally, or we could still be in the very early stages of a new bull market with the bear market over, or somewhere in between. It could be, we could be looking at a bear market rally, and that's at my most optimistic scenario right now, that could last weeks but still have another double digits, 10% or more to go. And so hopefully you're going to find some value in this. I know I do. Again, just reviewing my previous analysis and recognizing, okay, what did I miss? How did I miss so many of my stocks coming down to key support levels that were, forecasted at the beginning of the year, and then along the way? That's the worst part. And so, I just guess I had my head up my butt here, and I plan to remove it and screw it back on over the weekend. Whether I, and if I don't have a clear consensus of where we're going, other than at least a decent near-term pullback, then I'll step back and keep things light and wait till I can have a much stronger opinion. So all right, let's dive into the charts. Let me get rid of this for you. And what I'm going to do is hit play. I'm going to just go over parts of that video again that was recorded. All the videos are timestamped January 4th right there. And this is QQQ. So on what we're going to do here, I'm just talking about, well, I'm not going to show the whole video because that video was 45 minutes, you can see. So I spent the beginning of the first 5 minutes showing in detail, without any exceptions, one of the most accurate, reliable indicators. And this, to me, again, the takeaway is, if nothing else, you can use this along with the other indicators. Again, I don't use any one indicator by itself, but this is one of the most reliable, accurate indicators out there, and that is simply the PPO. Using the PPO, and if you put the histogram up, in which I was focused on, it shows you when the lines cross. So what I had showed you well, let me go ahead and play the video, and then I'll jump back to remember that was then beginning of the year, and I'll play that, and then I'll come back into the video and show you that this is now, and we'll do that for a handful of individual stocks and show you their targets, and then how they look, more importantly, from here going forward. Take it as it comes. But as of now, we have a solid PPO crossover on the monthly chart. Again, that will be finalized if we close where we're at right now in QQQ or anywhere below. We're guaranteed to have that crossover stick. Even if we flattened out, because it's a momentum indicator and the momentum's already shifted, you've got to go up from here. The Qs are going to need to rally off this minor trend line to keep that PPO or to turn it back green by the end of the month. So what is the takeaway? Again, here's the takeaway. We have drops ranging from nothing less than low double digits to solid double digits. All right, let me just stop it there. You got that. You got the gist of it. I said this a dozen times. So that was then. Now let's do the this is now. And again, this is something that happened all along the way, many updates. This is the same exact chart, might have a few extra levels added here, but beginning of the year, we were right here when I was doing the video, and then you can see there's our confirming sell candle right there, and you can see the histogram member had crossed that month, and you got that close. So that was again, an extremely reliable signal. That was, and I said at the time, that's your get out of your 401k money. That is, get some shorts and start, scaling into swing or aka trend shorts. Because when I'm talking a monthly chart, I'm not talking a trade that's going to last hours, minutes, or even days like the 60-minute chart or those 10-minute charts I show you. These are your big bull and bear markets. And again, you can watch the whole video and see how reliable that was. Now, where are we? Now, the thing is, I use that to identify when a bear market has likely started, when a primary uptrend. And I also talk about that 20-month moving average, which then came as a confirming. That's a whole different indicator, but that confirmed a couple months later. But keep in mind, the bullish crossovers are going to come after. They're not going to get you out. That got you in real early. You would have been very happy to get in January and capture up to this point almost all of the bear market, or even more importantly, for those that are not very active traders or they don't short, you would have got out of your 401k, your growth funds particularly, which have a lot of tech in there and sidestep that. So where we're at now, well, let me show you where my targets were I laid out at the beginning of the year. So let me stop this part, clear this out. Okay, I'm jumping forward in that same video now, and skip forward. This is a 15. You can see the mark on the bottom, the 1526 mark. And again, this is where I lay out where I expect the market to be going based on these long-term sell signals we have. Okay, I'm going to roll it here. These primary uptrend lines here over time, and that's going to be about a 40-something% drop in the Qs. Okay, so that was it there. I just, again, I'm not going to play the whole thing. Calling it down to these primary uptrend lines. You can see I have two variations, and that was then. Let me give you this is now. Oh, sorry, I thought I paused the video. I was just trying to straighten it out here. I'm using a different monitor than I usually use. So I've got my little counter thing going on another one. So hopefully that all played. You got all that anyways. That was the previous video. And these are the trend lines here. Nope, we were on that was a weekly chart we were just looking at in the video. And these are the same trend lines. I'm not modified or touched them. The same price levels you saw on that one, which was later tasked to T3, which was 268, or the first trend line there. And again, that's what we hit. We hit it there. We first hit my third target there. We hit the price support level, 268.30 or so, whatever, right there. Then we hit the trend line afterwards. So they were both hit. T3 was, I said 268 of the trend line. And again, we did that. And when we took it out, we had that what I called the bear trap, the big fake down move, based on a Fed meeting there, and then a rally back above, leading into one of the most powerful setups in trading, which is a bear trap, a false breakdown followed by recovery. All the same, we hit the trend line and we're back above the trend line. So the trend line effectively held. We had some volatility and we've traded through it in the last few weeks, right? But all these candles, they close right about on or of either on the price support or the trend line, and now we're there. So again, in hindsight's 2020, but you know what? I'll get that next time. I would have been positioned aggressively long, especially when the recovery happened. Not so much on the breakdown, and on the contrary, the breakdown was a breakdown. And that's not a buy signal by any means. You can't foresee that. But once it recovered and we closed back the following week, that should have been pretty much an all-in, tuck it away with a stop below the recent lows, even if this is all that's going to be, because that would have still been a decent rally. That's about, it's nothing huge, because again, you would have had to wait to you've solidly recovered the level there, the trend line. So, last few days have been big. Then you can play the what if game, but it still would have been a good 5, depending on where you entered, 5-7%. And you could either rat stops up or move stops up to entry and then swing up here. Again, this may all be over soon and we may have that final leg down. I am not at any means rolling that out. What I'm doing is showing you some of the things I missed and how I would have done it different. And again, I will follow up more so next week, because I'm still a little bit skeptical of the rally, of this move over the last couple days, for many of the reasons I've said already. But you can see now what's happening too is if we continue to rally next week or so, you're going to get a confirmed bullish PPO crossover. Remember, I've told you all along this was potential divergence. I've showed you back in 2008 how we had an almost identical divergent low back then. and in the middle of the bear market, and that was followed just as it looked good and just as the market started to rally about this much, the big final wave down came, the big most powerful wave of selling. And so I am, like I said, the only thing I don't like about that is how almost how perfectly it would play out. And no two bear markets are going to play out the same. This one fundamentally is a lot different. That bear market at that time, you saw the Fed at that point in history, or that point in the bear market, going to the easiest Fed we've seen in decades, if not ever, go into a zero rate policy and quantitative easing starting and all that good stuff, or maybe that came right after. In this time around, it's the other way. We're tightening and doing quantitative tightening and raising short-term rates. So I will again, do more follow-up to this. Let's just jump ahead and look at some other things there. But most importantly, again, from the beginning of the year right here, this is exactly where I was calling for in that video. And you're going to see in a second here some stocks that were even more precise on these calls. And again, those are the things I missed. And so can't go back, wind the hands back a time. Although many of those were pointed out hitting those targets. Maybe some of you took those. But the more important part is, okay, how much they bounced off those targets. We're going to get to in a second. Is that bounce over? Or about to be over? And do we turn around and now get ready to short those stocks and or the market? Is there more to come on those bounce and then we're going to take another leg down? Or, and this is the big if, we'll get to that, is at the end of the bear market. And we put in a divergent low, and for many years, for decades now, positive divergences on the weekly charts were often the catalyst for a move to new highs in the market, or they mark the end of bear markets, like back in 2009 when the last bear market ended. Okay, I'm going to start out with the biggest stock, the most important of all, and that's Apple, and the only one, and something that tells me that we're just in a bear market rally. It's not over, because this is the only one that hasn't hit my bear market target. I didn't lay out in this video, at least, I didn't lay out specific targets. Later on, I added some, but I did lay out a target that I still maintain, and I've added horizontal level since. Let me just play the video and tell you what I was saying back then about Apple. And this was, by the way, I believe this was the stock hit the all-time high the day before this video was recorded, if I'm not mistaken. So where does Apple go? Well, hasn't checked this trend line in a long time. You got a primary uptrend line right there on the weekly, and to get there, again, depending on when we get there, you're talking stock could get cut in half. And again, that's an aggressive, very longer term target. I don't know if it'll get there or not. All I can tell you is that every indicator that I have, every chart that I look at, every time frame tells me not a correction, but a big drop is coming in the markets. Again, I'm going over this twice. Okay, so now let's look at Apple. And again, Apple has, in my opinion, kept the bear market that we're in now, what I would consider a mild bear market, and not on par with previous true bear markets. We're talking 2000 to 2002, 2007 to 2009. But since I've since added levels along the way, remember that was in the beginning of the year, and including this big support zone right here, which we've been bouncing off from 160. What is that? 136 is very good support. And as I mentioned, we're below the 200. So from there, we did go on. We went out and broke down. This is a trend line I had back then, this blue trend line, and that was our sell signal, our first one. We went down and we back tested it, same trend line from that video, and we've been holding this support. So Apple, before all this bear market is said and done, I believe we're going to go down there. And it's going to be, as I've been stating all along, this isn't going to be like any of the bear markets we've had for decades now. I believe it'll be much different, much longer. Those were relatively quick, 15, 18 months, the last two in decades, the 2000 to 2002 and the 07 to 09. So this one will play out, and there'll be plenty of rallies along the way. And again, part of the point of this video is how much more meat in the bone is left in this rally, assuming I'm right, and assuming that in the coming months to years that Apple's headed down here. Okay, and if not, when am I wrong? Well, we start taking back the key moving averages. There's a downtrend line off the highs, things like that. And we're not even close to that yet. We're nowhere, again, technically speaking, even though it's possible that a new bull market's underway and the stock market's going to new highs. Anything's possible. I speak in probabilities, and that's what this video is all about. But what I was going to say is there is not a single metric that says it's over. There's a case that can be made, positive divergences, bullish engulfing candles, market breadth improvement in some indicators, certain sentiment indicators spiking to extreme levels, but not others. So again, a case can be made, but technically speaking, we're still in a downtrend in the overall market. So let's get to the rest now, and then you'll see some of these calls that were, some of these stocks that hit these longer term targets. Okay, I'm going to play the video here on coverage of Microsoft, calling for the target on that one. Trend line, which is a potential longer term target. Big support down here at 228.81. My minimum target, should this, if and when this trend line breaks. Okay, 228.81. That was then. This is now 228.81. We reached it just like the stock market, overshot, and it was a really good target. And again, the key takeaway, my minimum target. So my minimum targets have been hit. In those, when I have if I'm swinging, in this case, calling bear market targets, I call those off the weekly and monthly charts. So when you hit one, again, each target, the reason I list multiple price targets is the tag of each target is where I expect a reaction. We certainly bounced the first time we hit it, sliced through. Again, we held it. We had one weekly close. And the fact that we recovered is even more bullish than just bouncing off the level. If you just bounce off it, then that's one thing, and hey, that's great. But to go down below a key support level that's very visible to me, hopefully others, and then undercut it, and that brings in some short sellers. Even leads me to believe that when you break a support level, you're going down to the next one. But nope, we recovered it. And again, it was that at that point. So at that point, and then when we did it, we had, Microsoft burned through the divergence. It still has RSI divergence, but the fact we recovered it, that made it a bear trap. And so far, we've been building on it. And from the look of this chart, again, this is, these were all the potential bear market targets, and they're still potential targets. And like I said, after yesterday and today being up again, it just increases the odds that Microsoft may want to run at. See, a lot of the stocks, just like the S&P 500, NASDAQ 100, they have very clean, these are bear market downtrend lines. So when I say minimum target, that's what I meant back then, right here in the beginning of the year. Right there was our sell signal. Everything broke down. I've never in my life, or I should say very few points in my life, seen such a strong case to get out of the market and start shorting with these weekly and monthly charts and trend indicators rolling. And then so many stocks broke support around the same time, market leaders, and they went down to where they should have. And again, so are we going to get this and then this, which is what I'm leaning towards, whether it goes all the way up that far or not. That almost makes it too easy. So many eyes are going to see these levels, and maybe they get hit, maybe they get popped, but we could get sold into them. We're not going to know this week. We'll know next week if we're going to continue to build on these gains. And I've been showing you some near-term resistance levels. I could add a line right here, but I just wanted to show you again. That is all day long. Remember, there was a lot of volatility over the last few weeks with the Fed meetings and earnings season, and that's what caused us to kind of chop and grind around that target. But that was a call of, in the beginning of the year, January 4th, where that's right here. This is the week of that week, and that was a call of a 36% drop in one of the world's largest companies, almost to the button, not to the button on that one, but close enough for government work. The target was hit and then just traded through for a while. All right, next up. Okay, back to the video from January 4th. This is coverage of Amazon, which again was right up near all-time bull market highs, like all the other FANGs, the rest of the stock market. So I'm going to hit play here. Divergent high, and therefore I think Amazon will come back down here when this next bear market's run its course, at minimum about a 39% drop down to about the 2043 level. Tesla. Okay, so that was then. Amazon. Again, a lot of these charts just haven't needed to be. They haven't. I haven't needed to modify them. Some I added additional levels. So Amazon had a split. That's right. So that was the comparable. That was the same level. These lines had to be. They had a 20. What was it? Right here it tells you 20 for one split at that point. But that's that same level, and that was a minimum target. And that was, remember, that's where we went long. Each and every pullback to that level was pointed out as a long. There was a first trade there, and that closed out, and then a second trade there. Then we broke it. And then this line was the same line. That's that same exact level. Again, the price level is different that was on that chart. And so once we broke that one did go down all the way. Again, within what I tell you yesterday or today, 2% of that next target, which was on that chart back then. But it also with positive divergence, not yet confirmed, but you're talking again one of the world's largest companies, and that's a 54% drop. And I hit my minimum target, which was a 45% drop off the highs. That's a big, the stock got cut in half. Rarely, you haven't seen stocks like these market leaders get cut in half. It didn't even happen in COVID. The big ones, they held up, the market leading things. So it was back to the last Great Recession in 2008, 2000, into the '09 lows. But with that being said, that's close enough to that level there, and this one has strong positive divergence on the weekly, and that could carry that stock up. Remember, that was support, and it's going to be resistance. This is going to be, probably tough sledding. And again, I'm going to let you, I'm going to continue to study these charts over the week to see, over the weekend, to see if, how much more upside is likely and how that's likely to play out. In other words, where are the objective entries? And again, a lot of these you can just draw downtrend lines either off the highs like that, or look at the moving averages. That would be technically, there's the primary downtrend line off the high like there, and that's a pretty big bounce. But here's the thing. All right, let me add that trend line right now. All right, so I'm going to go to the highs. This is what we have to look at, and this is what we have to consider, not what's possible, because anything's possible, but what's probable. A bear market rally, even as much as Amazon's come off the lows in the last just the last couple of days here, if we worked our way up there, remember, it's not going to be a straight shot. To get to the 200-day moving averages, you're still talking at least another 26% upside. And if it took us a while to get to this trend line and maybe that key 135.28 level, well, that's potentially 35% more upside. And in its own right, that would be considered by many a bull market. But then when we look at fibs, let's just put the all-time. Let's look at the bear market drop so far. That would be if we got up there. Well, here's your fibs right here, your Fibonacci retracement levels. This is the 38.2% retracement, and that's right to the 200-day moving averages, which are 40 weeks here. And then if we hit maybe that the primary downtrend line, that would take us up to the fib. So here's where am I going with this? As powerful as that would be a rally of anywhere from to the 38 to 45% and to the 50% fib 60%. And you might say, wow, that's a bull market. And no, everything's relative. It's a bull market by the antiquated definition of a 20% rally. But in this case, it would only be a bear market rally. By the way, a run of the mill, even a 61.8% retracement of a previous move is just counter trend within the norm of a counter trend move. And so, however, do you want to be short or do you not want to be long? And that's what I'm trying to figure out here, is at what point, and so far today, the fact they built on yesterday's rally, and certainly if they build on it next week, that's going to further increase the odds. And then at that point, I'll start looking for some, especially those things that haven't popped yet. But as of now, like I said, we've come down to the furthest target that I had on the chart back in the beginning of the year, just when right at the time the bear market started, before anybody knew, because the market was at all-time highs. So, and that says, look, at the very least, that may have satisfied that initial bear market target. That's what I keep referring to, little semantics here, but I have my, what I keep calling initial bear market targets, and that means expect a bear market rally, which would be considered by many a bull market after those initial targets are going to be hit. And that may be in play now. We'll see. I'll get more on that later. Okay, here's where some of the calls start getting even a little more precise. And again, remember these are massive calls. You don't see things like this on CNBC. So this is Tesla around the 23-minute mark here, and let's go ahead and start that one. And the divergence is even larger now. Anyone that doesn't think the electric car, especially Tesla, with this insane valuations, is a bubble, well, anyways. So where do we go? That's not the point of this, is not to give targets right now on each and every one. If I see something that stands out, I'll just tell you right now. I still have, yeah, I've had this for a long time. We already hit it once, but I think again, about 570 right there. I think that's a minimum target right there, and that'd be about a 51, 52% drop in Tesla. Okay. So yes, I did say, the whole point of this video was macro analysis long term. And although yes, but I was laying out targets and showing you where each one was likely headed, despite saying that. But here, that was Tesla then, and remember, Tesla also split. So what you're looking at, I'm going to jump over to the current chart, but that target, what I said minimum target, 567.97 was this whole support shelf right here. So that was then, and this is now. Grab it here. Somewhere here I have it. Oh, there it is. I can't, with the annotations up. That's that same level, split adjusted. The line's not moved. That's those lows. That's a to the button tag. And again, that's a call from January, the beginning of the year, right there, week of January 7th. So, one of the most beloved stocks on Wall Street, Tesla, calling for that was a 50% drop, and that's what we got. And again, the point here is, takeaway is, when I look through the charts today, I'm like, my goodness, how many of these hit these targets perfectly? And that's big support. And how many did so, like Tesla, with positive divergence? I pointed out Tesla just the other day at key support. Um, and I was talking about what happens if Bitcoin crash is going to take these, or if these stocks, and they held. I got to give it. Apple held the support, Tesla held. So far, everything is held, and that's the point. So we're only just now hitting, for the first time in many cases. Remember, the indexes and some of the other big things hit earlier on, hit my third targets, those initial bear market targets, and then bounce. But some of these, like Tesla and some others, I'm going to get to a few others, just hit it. So therefore, there may be a little meat on the bone here, or if this is going to be a vicious bear market. I've mentioned this many times. I've seen bear markets. Many come to mind. It's really at what point in the bear market are you in? 2000, the 2000 to 2002 bear market, the 07, 08. Those are the ones that are 07 to 09 in modern history. Those are the ones that I've traded through as a trader. I was a licensed stockbroker back in the early 90s. I used to, sell stocks, and then later on in my career, I decided I loved it so much I wanted to buy and sell them for my own account, not selling, stocks to other people or taking orders. And so that's my point is, those are the bear markets that I've traded through. Everything since early 2007, when I resigned, decided to change careers and trade for myself, because it became an issue. I was trading so actively, and back then they didn't want stockbrokers trading in their own account because of the conflicts of interest, front running, and all those other issues. So you had to compliance department said one or the other. So anyways, give my notice and never look back, and best decision I've ever made in my life. But where I'm going is, some of those bear markets, you hit these levels, and quite often they can act, especially when you hit that point of impulsive selling. Support levels act as mere speed bumps on the way down, where you might have a tag, and instead of consolidating or revisiting that level a few times, you may just kiss it once, have a little bounce, the buyers are going to come in, and then you drop to the next level. So the next levels on Tesla are, you can see there's the primary uptrend line, and that's quite a bit lower right there. Okay, just a few more to go here, and we've got a couple chip stocks. And again, these are the big leaders in the Nasdaq 100 or S&P 500, at least up there in the top 10 or 15 or so components. And this one, NVIDIA. Now this one I've updated quite a bit before and since, but let me just roll tape, and then we'll go to where we're at, which was us just hitting one of my major targets here. Let me go ahead and hit play. I'm going to add one. I listed these targets months ago. I'm going to give you one more right here. I think we'll get some. Well, I'll tell you, there's reactions along the way. I don't want to lay out targets right now as firm targets. I'll firm it up later if I cover this as an individual trade idea. And then don't forget, I mean, here's a long-term secular, which by the way, I'm pausing the video now, which I did do later on. I reaffirmed and resequenced those targets, but I'll go ahead and finish this. Bull market trend line. Lots of reactions in the past, and that thing hasn't been visited forever. This is just the era of easy money right here. Fed started gunning the system full of cash in '08, and this one's been a beneficiary. So ultimately, it could work its way down there and still be in a longer-term bull market. That's your secular bull market uptrend line. Alphabet. Okay, so that was then. This is now in NVIDIA right here. Those are those same targets, and that was T2. So we went down. They were later firmed up. And again, this one was pointed out recently. We hit T2. We hit, first of all, we hit T1. We had a tradable bounce. Went through it again, bounce again, then took it out, hit it. And this one I've updated quite a bit. And this is a big one, again, because this is kind of gives you a pulse. This is the new NVIDIA, AMD. Intel is so beat down. These are the guys that have been the big chip leaders in the last several years. And but now where are we going? Again, look, we bounced back to T1. This is a weekly candle. It's slightly above it, but T1 was resistance, and that's where we're at right now. And then you have your big moving averages. Again, love these, especially tech stocks. Not all stocks, but the 40-week simple and exponential moving average, because some traders use simple, some use exponential. Therefore, I use them both. But they just do phenomenal jobs of defining uptrends, and when they break, you're in a downtrend, and boom. And then when you're in that downtrend, you come back to them and they act as resistance, resistance, resistance. But once you regain them, then your downtrend's over. You start a new uptrend. You buy the pullbacks to it. That was COVID. You hit, and that candle closed right on it, intra-week pierce, a perfect tag, and it would have kept you long or let you get in long if you had missed it before. And it's staying every single time as long as the bull market continued. Pullbacks that level contained those moving averages contained pullbacks until we clearly took those levels out, the 200-day / 40 weeks, and then you run up at them and you get rejected, and that's it. So this one's coming up at them. And so again, you have other tech stocks, other market leaders that have a little more room to go. But then you have some that are starting to hit here. So just like, and this is a takeaway from this video, just like a few weeks back, remember, we had QQQ a couple month and a half ago or more, first hit my third target. Here, let me go to that. And that was pretty much, you could have covered everything there and gone all long and stayed long. We're back above there. So you basically just had a second successful test. So when you look at it in reverse now, so this is kind of where I'm going with this. So you go back to NVIDIA, and you're going to have some of these stocks soon start hitting those key moving averages, and you're going to see sellers step in. You're going to have other stocks, like I covered in today's earlier video, Alphabet and Amazon, coming back to major resistance levels. There's Amazon's a huge company, big psychological and weighting in importance in the indexes, and it's coming back to that big 103.31 level. Not a lot of upside left, and so that's why I'm doing this video, guys. And I'll give you more of my thoughts next week, whether this is just kind of a 1-week wonder, big bear market rally, and then boom, we go down to some of the deeper targets. And some of these stocks I gave you deeper targets, and I'll be working more on that, especially if we start making another rundown, because at this point, you've got a lot of stocks coming off that divergent low. You have the bullish engulfing candles on the indexes. They have no business being violated. I'm talking about QQQ and SPY on the daily chart. The bottom, the lows, those were followed. We had bullish engulfing candles on those days. And so if we take those out, I continue to maintain, and I think they will. To me, it's more a matter of time. But I think from there, you're going to have a waterfall down and the next leg down. But that could be months away. It could even be mid to late next year, or it could be next week. I know that sounds crazy, but that's how the market works. And I've showed you before, and I made a big point to show you what happens. These big bull market rallies like today, or yesterday I should say, are often 1 or 2 day wonders. They're followed within the next day or two with an answer the market answers to the downside on those. So this time around, like I said, we've got about as bullish case as I could make, and that bullish case seems to be firming up the last couple of days, and we'll see. We'll know next week, I think, if this is just a brief little head fake here in a bear market with another move down. Okay, next up, you're gonna like this one, ASML. Let me hit play from the video here real quick. One, target 2, and ultimately target 3 down there about 402. Maybe even this uptrend line. They probably will come in together if and when we get there. It all depends on how this plays out. If 6 months from now the markets continue to make new highs, and I'm talking about this stuff as long. So there it is. So even though twice in the video, so well, the point of this isn't targets. I laid out targets in every single stock. 402.91 and the trend line, and I said they'd probably both come in around together. Check out the precision on this one right here. ASML, that was in. This is now ASML. We were on the weekly chart. It doesn't get much better than that. There's that uptrend line again, unmodified, same original uptrend line. It's your primary bull market uptrend line. And again, point of this is I'm kicking myself seeing, and I hadn't gone through as many individual charts, because I always say the stock market, an index or a sector, is simply a sum of its parts. And when you have multiple semis, the semis are the canary of the coal mine for the tech sector. They were weak on the way early on, and I showed you these aggressive downside targets. I guarantee you there's not many analysts or anybody in the world that would have predicted that ASML, as bullish as everybody was coming into the beginning of the year, would drop 60% or more off the highs. But that was the target. We hit the first target there, bounced, came down, then hit the trend line. Look at that, to the button, unmodified. This trend line's not been changed since created that back in 2020. And we bounced off it. And again, this one shot up. Now here's one that's already taken out a downtrend line and moving averages. So this is what I'm going to look at. Whereas a lot of other semis and other tech stocks haven't yet rallied back to the 40-week / 200-day moving averages or their primary uptrend lines. This one has. This one exploded through there this week. And so that could be a tell. That could tell, and look, when we hit it, I'll just add it now. And this is why, this one I stumbled upon one of many today, and that's what prompted me to do this video. I looked at these targets. I'm like, geez, I had numerous stocks hit the targets that were laid out. And these, by the way, were covered throughout the year, not just that January 4th video. I did many updates on the semis early on, reiterating and refining these targets. And that one also had positive divergence on the weekly. How I missed that and how I didn't just tuck away, pretty aggressive position, again, with stops underneath. It's a lesson learned, and one that hopefully I won't repeat again. I've had a great year all along. Last couple days kind of sucked, being shorting on the indexes on NQ. I've had a lot of commodity hedges help offset that, unfortunately, or I should say fortunately, but still, to me, it's more about missing a move like this in many of these in the semis and everything else when the signs were there. A lot of evidence that these targets were hit, especially then after you hit that first one. There's that example there. That's when QQQ hit the first time. It hit the third target on the weekly. Then we came down. We had those false breakdowns, aka bear traps, followed by the recovery. And at that point, that in hindsight again would have been, hey, go aggressively long right here. And I did say it for you guys, so hopefully some took the advice that I didn't take. 401k money, load back up in the 401k with just a stop below the recent lows, because therefore we have a bear trap, potential bear trap, and if we take it back, if we go back down, then it's a breakdown. It would have then been a breakdown of 402.90, a confirmed breakdown, and that little up would have been the whipsaw. But so far, well, we can now see clearly the market hasn't looked back, or at least a lot of stocks like this since then. All right, guys, I only have a couple more, and then I'll wrap it up, and I can get to my weekend, and you can get to yours. Okay, next up in the video is Cisco. It's a big one, big tech company here. Let me roll video. Yeah, it's trading at all-time highs. It's a resilient market, but a marginal high. And I always say that breakouts that occur with negative divergence. This is what's happening right now on that 60-minute chart on the indexes. say this often. So there, again, this was done at the all-time high. You would probably be extremely hard pressed to find any bear, anybody wanting to short Cisco back then. But let me go ahead and play tape and you'll see what happened. Have a much higher rate of failing than breakouts that do not have the divergence when they occur. Netflix. Oh, sorry guys, let me just back up on Cisco. There you can see there's my primary uptrend line right there and $40 support. That was then, this is now. I might not have drawn the arrows down, but you can see it on the chart. Again, these are, and let me get to the current chart and I'll show you. Cisco. All right, this is what I'm talking about. This is why I'm doing this video. It may seem repetitive to you, but stock after stock, not every single stock, but a lot, too many to ignore, hit these key bull market uptrend lines. This is, a major uptrend line from the 2011 lows. It might even go back further if I extend it. Might even catch. No, it's not going to go back to the. Oh, that's it. So that's where I had it before, and you can see it's a great trend line. 1, 2, 3, 4, 5. Multiple reactions here. You overshot it briefly, and again, that was the story of this bottom. Why it was a little bit tricky. It undercut most of these levels just briefly. One day it was really, and it was a Fed day, and in doing so, you had, it's not drawn here, but I'll draw it in for you now. You've got it, positive divergence. So this is me in hindsight. A lot of this analysis, I mean, that was foresight, or all this whole video was. But in hindsight, right now, today, looking at these, and not spending more time recently going through the components, all these stocks, you really got to dig down deep at times. And having seen this and every other thing I've talked about so far, yeah, that would have, I wouldn't have been so wishy-washy about this being a potential bottom and the divergences and all that, but then going down. Again, the trading strategy is simple. It's, there's still no guarantees that it will be or prove to be, or we're going to go up anymore, but I do want to point out Cisco is at a downtrend line right now. Put in a divergent low, but that also forms a bullish falling wedge. Looks a little premature to break out, but if it did, then your downtrend line and then your targets are the same ones on the downside that were support levels, then become resistance or potential targets. And like everything else at most, I think it would be a bear market rally, and then we're coming down here ultimately to 29.50. And so those that don't believe that probably wouldn't have believed here we were going to go to where we're at. And that's, again, I'm looking at a much bigger bear market in the coming years, not months, but coming years than I think than any we've seen in decades. And so it's a matter of trying to, get in front of the next move. Seeing how much, if any, is left on the upside on this move, and then more, as importantly, getting out of those longs and getting a short trend position for the next swing down. All right, let me give you two more. Let's see, we have Comcast, Intel, Intuit, AMD, and Applied Materials. No, I tweaked it. Sorry for the pause, guys. I've clicked over. I was studying the charts. All right, doesn't matter. Either way, it's close enough, and I did tweak it. That line did get moved. I had it right here before. This is the old video. I've moved it down since. Okay, just trying to skip through these quickly. Intuit, right, this is a big one right here. Here's the video. So break of this trend line, and solid break or weekly close below it should take us down to the primary uptrend line, and depending on when it's hit, that'd be about a 44% drop. Again. Okay, so that was then. This look at this. This is just again, to me, I'm laughing, but it's not haha funny. It's just how many I missed coming down. That's the same trend line, unmodified, to the button. That is a to the button call right there. And again, it's not trying to tout my own horn here because I missed this. I should have been, going to a pretty aggressive long position with stops a little bit below there. This is not one. This is, at least in this video, a dozen, but I have others that numerous stocks falling to key support levels, including but not limited to those market-leading fangs. So, again, lesson learned. And look, here's also another one. Look at Intuit again, where we're at now, and this is the part I'm going to work going forward because I only share hindsight analysis if there is an educational takeaway or learning lesson, both for myself and you guys. But there's, held up those 200 days. It broke right there. We flagged. There was a little bear flagging on the back side of them, and then boom, they tried to rally, got rejected. Tried to rally, rejected off the 200, and then boom, rejected again more recently. So this is bear market action, and you want to just go back to previous bear markets, and you can see some more than others. This one back in 2000, we'll pull it up real tight to the dot-com bubble, and you can see that stock. Once it crossed under those, it acted well. There are times where a stock won't act as well. In choppy trading ranges, I ignore it. But there are periods where these 200s or any moving average, sometimes it's the 40-week or the 20-month moving average, different ones act as good support and resistance levels on other stocks. So here's the story. We just got rejected off it relatively recently. Now we could go take it out, but again, so this one, like a lot of others, is still in a downtrend. You also have your primary bear market downtrend line. And so what happens here, and another takeaway, and I need to say these things, that this could be a speed bump on the road to a much bigger drop. If this bear market, if we're going down to where I think we're going to go, it's not going to make it easy for the masses. Right when it looks good, when the rallies start to look good, that's probably when you're going to start to take out some of the bull market trend lines. Because as big as this drop is, and I've said this, and this is just me, this is my way of thinking in the markets, it's a 50% drop. Intuit got cut in half. Yeah, they make a TurboTax, MailChimp, where you get the emails from my site. I use that's one of the biggest mass mail marketing providers. You have to use those companies if you're sending out more than a handful of emails, or they'll get caught up in every mail provider's spam. So you're going to pay for those services. Big company, right? 50% drop. But all that was, you can say what you want. Many will call it a bear market by the old school definition, but it's just a correction back to the primary trend line. That's the point here. This is our bull market uptrend line. So far, this has been since the 2008 lows. Probably go down in history as the greatest bull market ever. I don't know if it rivals the one leading up to the 29 crash, but this has been a Fed-induced bull market, and so I've made the case that even COVID was just a correction back to the primary uptrend line, and you can see it in indexes as well. And so where am I going with this? Well, nothing lasts forever, and the bigger a bubble, the bigger the Fed has kept an artificially high market for many years and disallowed the usual corrections, bear markets that are needed to flush out the excesses in the system. So therefore, where I'm going is this seems like a blow-off top in many stocks and the market in one of the biggest bull markets in history, and the fact that interest rates have now begun a new secular bull market by my analysis that says we're going to be looking at a bear market, and maybe it's going to be easy and we get these nice rallies, but usually after a big blow off top like this, you'll come down and then you'll just keep going. You'll take out those key support levels. We've already checked them once. We had a nice bounce there, and so look for that. And if that breaks, I'll be giving you longer term targets. I'm probably thinking just eyeballing this at least down here. But again, we'll do price targets if and when. Right now, it's more of a matter I've got to figure out, are we going to go up more from here and how much more? And that's what I'll be working on over the next week or so. All right, I've given you so many, and let me just see AMD. We don't need to go to the video. You can kind of get the point. AMD. All right, I'll just have to do it for you.
All double-digit.
This is the video for AMD. Let me just show you real quick here. Corrections along the way, but when we break the primary trend line, especially considering the scope of these divergences, we're looking at pretty big, sizable corrections, and I think so. That's 58.91 there, and that was then, and this is now, and again, may be repetitive, but this is how I have to look. It's if one stock, two stocks hit a support level in a bear market or at a downtrend, that's one thing. But when dozens hit, there it is, 58.91, and that was even before there was the breakdown. It was the beginning of the year. So was I on this chart, this time frame? I believe I was. It must have been. Yep. Either way, yeah, that we know that was in the beginning of the year, right there. There's January line right there, right off the highs, and so to the button, almost to the button, a little bit like everything else. Not all of them. Some were to the button. That was a 1 week, one candle overshoot followed by recovery. But look, here's where we're at. So this is why this is where it gets tough for me. That's why I'm talking for an hour here. That's big. That was huge support. And when it gave way, it was waterfall sell. And just like Amazon, it's bounced back now to that big support level. And that could be it. That may be all there is. Or we may take, if we take that back and we start seeing Amazon take back the comparable support level and many others, and that's what, again, I'll be pouring over the charts. Amazon's got a little room left to go to hit the 103.31 level, but you start seeing those levels get regained, and hey, that's going to be bullish. Until then, we could get rejected, and if we do, it could be a very sudden and swift down move in the markets. And one of the things among many I'm watching is commodities and other signs that inflation is either abating and going to, because this market this week has 110% priced in the fact that based on the CPI number that came out 2 days or yesterday, that the Fed's going to all of a sudden pivot. And that's a dangerous assumption. But again, it was also technically based. It wasn't just a random out of nowhere rally. You know, we've had the bullish charts recently. All right, guys, I think that was it. No, the last one, and it's ironic because this is the one that started where I started to note earlier today how many of these stocks hit the key support level, and that's going to be Applied Materials, and then we'll wrap this video up. Okay, last one of the video, and this is Applied Material, January 4th, high, and we're at all-time highs. So there's a correction coming. Here's my target right there, 56% drop. And okay, that is that was then, and this is now. And again, you know, you're calling a 56% drop on Applied Materials, by the way, is one of the leading chip equipment makers. They're the companies that make the equipment that chip companies use. And if I have always said, if the tech sector is the canary of the coal mine for technology, technology is the leading sector of the market, then the chip equipment makers are the canary in the coal mine for the chip sector, because when chip companies, after a bear market or a glut, a downtrend, they start ordering the equipment to make new chips before the cycle begins, before you see it really the chip stocks rallying. And so there was a target, and this is another one that is a to the button hit right there. Again, a beautiful, just to me, a beautiful display of technical analysis, nice clean uptrend line, weekly chart. So your takeaways long term, you're an investor, a trend trader, 401k, retiree, you can use these weekly charts to predict the same bearish rising wedge pattern that I might trade on a 15-minute chart or a 60-minute chart for a quick pullback. Was able to, and there was your breakdown candle. There were the 200s getting taken out and back tested multiple, and there was that 50% drop called for, or 56% drop called for on January 4th to the button. And again, what's not shown here, positive divergence when it was hit right there. The price is making a lower low, and how and why I missed that, well, again, hopefully won't make that mistake again. And the takeaway is not getting lost in the world of the charts, looking at the same index charts over and over in sectors, which I do, and the market leaders. I did a lot of analysis, and I always do on the market leading FANGs, but then digging down deeper. I had to get, like I said, at least 50 stocks down in the S&P 500 to come across these and look at the charts and the annotations that I had, because some of these, like Applied Materials, I have not updated since I did updates on the chip sector along the way down, but it's been a little while since I did a deep dive into the chip semiconductor sector. And but look at that explosive rally. You know, that would have been a monster trade to have shorted there, held it to that 55% drop. That's effectively a double on your money right there, and then turned around. But look where we're at now. We're at that previous reaction high, and we're also parked the week just right above the 200-day, but not by a large margin. And remember, when you have a lot of upside momentum, it's what I call momentum fueled overshoot. When you're heading up vertically like that, it's more than common to overshoot a level. So I wouldn't call that a takeout. In fact, I would put good odds you're going to get a rejection next week, because to burn up that much fuel from that 70-50 tag of that target, that's a 55% rally without taking a breath. Yeah, I doubt we're going to go up much more without a nice pullback before then. And plus, I'm going to put up for you now, you can see traders always look at big major reaction highs right there. So there's a reaction high. And then what I'll do, and I can't do it in this video, or I'd go for 3 hours instead of 1 hour, I'll go to the daily charts. And again, you know, there was that divergent low, missed obviously in hindsight, but I start marking this up. I look at the dailies, I look at the weekly charts, I look at the 60-minute charts, I look at trend lines and Fibonacci's, and then it all kind of gets crunched in, and that's where we're at. So I'll end the week here. We rallied, a lot of things hit or at resistance, near-term overbought. I'm going home the weekend short. Came into the day short. Didn't work out good for me today, but that's fine. I've got other things that did go up, commodities and treasuries and things like that. So all in all, a good day. Overall, actually, treasuries ended up closing the day slightly down. They were up at one point, about flat. But again, we'll pick it up next week. We're right on the 1 hour mark. This is probably the longest video I ever did, but important stuff, like I said, not just for future reference, but more so what happened recently and key levels to watch. And if nothing else, the takeaway is all these lows, I've been saying it for a while, it's really, you got a long way to get to take out the lows and aim at, but the stock market and market leading stocks, it's really the recent lows. With applied material, by the time, if we do, which I think we will ultimately get back down there again, it's going to be a while, but then that's at that point I turn my focus. I start going out to the monthly charts, and you can see I have long-term monthly trend lines like right here. I've had this one forever on applied materials, and this is where we're going. This is what I firmly believe based on the charts at this point in time. It's just a matter of how much more upside before we get there. That is, these go back to the 80s. These are my primary secular bull market uptrend lines in a lot of stocks, and including Apple and things like that. And that's where we're going in the coming months, I believe, 2 years. And so that from just where we're at today to get to that trend line in a reasonable amount of time would be another 44% drop in applied materials. And you also have a very good support level there as well. So I would put very high odds before this stock makes new all-time highs that it's going to come down to this, these next targets there. It's just a matter of, is there any more upside between now and then, and if so, how much more? And if anything less than that, then I'm just wrong. But nah, this one, it's coming back down. I can almost tell you. I can look at this. We haven't visited this long-term trend line in a while, since COVID right there, and it would be very unusual getting this far away from the trend line not to come tag it, even if the stock's going to go to all-time or new highs eventually, just like it got very far away from that trend line here and ultimately worked its way back before it continued the uptrend. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.